Hello, friends. Hope you are doing well, and I hope that you are continuing your learning in the markets. In this video, I will be discussing about what is the single biggest mistake that retail traders are doing and how they can avoid it and improve their trading results. So, to begin with, this video, I would like to take two quotes from two of the famous fund managers. I would say the first one is from Bruce Conner, who says that the novice traders trade 5 to 10 times too big. They are taking 5 to 10% risk on a trade, whereas they should be taking 1 to 2% risk on. Okay, that is first one. And the second one is from Larry Height, who says, I have two basic rules about winning in trading as well as in life. First, if you don't bet, you can't win. Second, if you lose all your chips, you can't bet. Okay. And what do we learn from these quotes, or what is the takeaway from these? Is to take very calculated risks. Okay. Instead of our focus only on profit, our main focus should be on how much risk are we taking on every trade that we do. And this calculation should be done beforehand before we punch our trades. So yes, the point is not respecting the risk is the main biggest mistake that the retail traders are doing, which is the ultimate reason they blow their accounts. Yes. So, what it means in simple terms is taking the huge risks per trade. Yeah. Okay. So, the outcomes of such a trading are no or very less room for mistakes because like as a retail trader, if someone trades with huge quantities, okay, then there is no room for mistakes because maybe one or two wrong trades will make them out of the market. Yes, it causes the irrecoverable catastrophic losses. And because of such random trading with huge quantities, the payoff graph that they get is very random. It's not like linear, whereas the professional traders always try to maintain that linear graph with like they always try to avoid those drawdowns. Yes, because of trading without risk management with big quantities, there is bound to be the emotional stress that the retail trader has to face, and because of such stress his discipline will get affected. Okay. And mostly, as you see, I have mentioned like the mindset of always have to be right is a wrong mindset that a retail trader carries. We should not have this mindset of always have to be right, because in the market there is nothing right or wrong which we can tell like 100%. There is no one who can predict the market 100%. If there is someone, that guy will be a billionaire. So because the nature of the market is there is no particular outcome that will happen, or there is no one who can predict it correctly 100% of the times. So we can actually guess the probability of what the outcome will be, but we cannot be sure of anything. That is why we should always uh, control our risk, okay, and let the reward be with the market. The market will sufficiently reward you when your view is right, your entry is right, your exit is right. But what that is not in our hand. The profit is not in our hand. What is in our hand is the risk. I will come to the point on how we can control our risk afterwards in this video, but let's continue with what are the outcomes of taking such big risks. Yes, there is a possibility of losing to an extent what we cannot afford to. Yeah, I think almost all of the points are pointing to the single thing, that is the loss of capital. Yeah. So in short, what this causes to a retail trader is the get rich quick mentality with which he trades by taking big risks, big positions, will lead to the get poor quick thing outcome, which is not the aim of trading. So, what is the solution of this? The solution is position sizing. So, what is position sizing? Is a different and a very deep concept in itself, but it is an instrument to control our risk, to mm, manage and uh, trade in a way that we actually make ourselves enough room to allow the mistakes to happen or to learn from the mistakes. So basically, the position size will give us enough room for our mistakes and learnings as we progress with our trading career. So here is a simple um, chart I have taken. It's handwritten. So as we can see, there are actually, uh, as we can see, it is going in the kind of steps. That is the normal way how the markets move upwards or downwards. S- Taking thinking that the market is uptrending in this particular chart, if say we are here, okay, and as we are seeing it is uptrending, okay, and it has taken support at this point, what we can do is we can take an entry here, okay. Obviously, to confirm that it has taken support, you need help of other things such as volume, and other technical indicators that you use in your trading decisions. If you believe that you the market is uptrending and you can go long, then what you can do is you can take an entry at say 102, just a sample random price that I have taken for to illustrate here, and you can put your stop loss below this particular swing low. So this is 100, so you can probably put your stop loss maybe at 99, okay. You have entered here, so your risk is 3, I would say. So 99 and 102, your risk is 3 points, and your reward here is I think reward, as I said, is not in our hand, but you can actually, with the help of any immediate resistances, you can calculate on how much is the possible reward. In this case, say if it is here, it is 107, this is 106 point, here. What we have to do for rewards is the way I use to book profits is by trailing stops. So the reward is I mean can be the one which we get from the market when the trailing stop is hit, when the market starts reversing. Yes. So here the entry is such a way that the risk is very limited and the reward is more. This is again a risk to reward, which is a different concept. But what I am trying to show here is how to calculate the position size. So the position size is nothing but, you can say you have probably 1 lakh capital. So 2% of 1 lakh is 2000 rupees. So say you want to risk only 2% of your capital, that is 2000 rupees. And what you can do here, you can calculate your position size by this formula. So 2000 divided by your entry price, that is 102, and your stop loss price, that is 99. So 102 minus 99 is 3. So 2000 divided by 3, whatever the value you get, that is the quantity that you need to uh, consider for your trade. So that much quantity you need to deploy in your trade. Say for example, here it's 2000 divided by 3, so that comes out to be 666. So on this instrument, whether it is stock or index, you need to buy just 666 quantities, okay, at the price of 102, and put your stop loss at 99. So your maximum risk is 2000 rupees if the uh, stock or the index starts turning from here and hits your stop loss. And as I said, the profit can be trailed if it is moving in our direction. So here is a very systematic illustration that I have done to demonstrate the effect of position sizing on uh, different kinds of traders. Okay, uh, starting from the high risk traders to the very low risk systematic traders. So in order to explain what this is, I actually have done this all on the Excel, and I have taken that snippet and kept it here. So see, the if say there are different kinds of traders, the trader category is the row name I have used for this. So a trader who takes the position sizing 100%, I have named him as trader 100. Trader whose position sizing is 75% per trade, I have named him trader 75. Similarly, a trader who trades with 2% risk per trade or 2% position sizing, I have named him as trader 2, and similarly 1% trader 1. Say that all these traders are given with the initial capital of 1 lakh rupees. As you can see here, they start with 1 lakh rupees, and these are the trades they are taking. Say they are taking 10 trades, and um, I am assuming the risk to reward is 1 is to 1. That is, whatever the amount they are risking, they are risking it to get same profit, similar kind of profit. So it is nothing but, if someone is risking 2000 rupees, he is expecting 2000 rupees profit on that trade. Whether he it's like either he will make 2000 profit or 2000 loss on any particular trade. That's an example. So here, let's go on with these trades. These are the random outcomes I have just taken to illustrate the capital, how uh, The position size will affect their capitals as the trades go on. Let's say the trade one is a failed trade. Okay, I have taken a very pessimistic approach in which I am thinking that the first trade itself is a failure, because the position sizing mistake is done mostly by the novice trader. So I have considered they are novice, they are new to the markets, and their initial trades are bound to fail. So, say their first trade itself fails. What happens is this particular trader 100 is a 100% risk taking trader. So, he deploys his complete 100% of this capital on that trade, and he is expecting it to give like 1:1 risk reward, right? He is expecting to make 1 lakh on that trade. So he is deploying 1 lakh, he is expecting it to make 1 lakh, but it's a failed trade. And so what happens is, since the trade failed and he had risked the whole 1 lakh rupees on that trade, he lost everything. And so his current capital after the first trade is zero. So he lost everything on the first trade itself. And yeah, there won't be any capital with him to trade further on the next 10 trades. So he lost in the first chance itself. And so his complete loss is 100%. Okay. So the trader who takes 75% risk, or the 75% position size per trade, he, as we can see here, he lost 75,000 on his first trade, because it is a failed trade, and he is left with 25,000. Similarly, the trader who takes 50% risk, he is left with 50,000, he lost 50,000. Trader who had taken position size of 25%, he lost 25,000 and he is left with 75,000. The trader who had position size of 10%, he lost 10,000, he is left with 90,000. Trader who had risked only 2% position size, he lost 2,000 and he is left with 98,000. Trader who risked only 1% per trade, who is left with 99,000, he lost only 1,000. So that's the thing how it is flowing. So say the second trade is a success trade. Obviously, the first trader is out of the market who was taking 100% risk. The second trader, he, since he is deploying 75% of the remaining capital, the 75% of the 25,000, okay, he will make the profit accordingly. He will make 75% of the 25,000 as the profit again. So it's 1:1 risk reward consideration for illustration. So here his capital increases to 43,000. So similarly here the 50% risk take position size trader, his capital increases to 75,000. Here 93, here 99, here 99,960, here 99,990. Okay. So similarly, uh, I have taken an example that maybe he will do 3 consecutive successful trades. Here, if we see here again, his capital increases the 276, and then 1,33,000, and so on. His final capital at the end of 10th trade, after those success fail, success fail trades, at the end, his capital, the remaining capital is 11,219. And from the starting 1 lakh rupees, he has lost he has lost about 88.8% of his capital. Okay, the 50% position size trader, he has lost about 28%. The 25% risk taking trader, that is the 25% position size trader, he has actually made a profit of 20.7, because his capital has now increased to 1 lakh 20,699. Similarly, the trader with 10% position size, he has made a profit of 16.5%. Trader with 2% position size, he has made a profit of 3.9%. And trader with 1% position size, he has made a profit of 2% only. So here, if we see, I have actually done I have plotted this on the chart on how their capital, their progressive capital flows, or how is their payoff graph, we can say. Here, if we see, uh, this is the first trader, with the blue line, the dark blue. He in the first trade itself, he went from 1 lakh to 0, and he is out of the market with remaining capital as 0 throughout. So this is what we need to avoid. Okay, we shouldn't risk our complete capital on a single trade. Even if, say, this would have been a success trade for this 100% capital risk trader, and the next trade would have been a failure, since he risks always the 100% of whatever he has, he will definitely blow up at any point of time uh, during his trading. Yeah. So this one we need to avoid. That is why I have done a cross mark. Second one is this line, the red line, the 75% position size trader. As we see, he came from 1 lakh to 25,000 here on the first trade. And then with the three consecutive success trades, he went above 1 lakh. Okay. He went all the way to 1,33,000. And then again, with the failure trades, with the single failure trade, again he came down so much. It's like again with success, failure. Ultimately, he came down. His capital came down. So this also we need to avoid, because you see there is so huge drawdown in his account, and emotionally stressful as well. So 75% risk taking is also should be avoided. The next is this gray color here, 50% risk taking trader. Again, he came down to 50,000. Okay, with three success trades, he went back to 1,68,000 here. But again, with success, failure trades, and success trades, ultimately his account came down, and this also should be avoided. Then the 25% risk taking trader is this yellow line. Here you see 25% risk taking trader. He is deploying, or he is risking only 25% of what he has. And with 1:1 risk reward in mind, he has done fairly well. Okay, so his capital went down um, to 75,000 on the failed trade. Sorry. And then again with the success trades, it went up to 1 lakh. With the three success trades, it went up to 1 lakh 46,000. Okay, and then with the losing trades, with the success trades, fail success, he has managed to stay positive, and he has achieved 20% return on his capital, which is good. But again, here, since you see the big drawdowns, these say with maybe 1 lakh capital, which is less, you will be able to manage the stress, the emotional impacts of this kind of fluctuations in your account. You will be able to manage. But say you are planning for the trading as your career, if you are, if you want to stay in the market for the long term, this kind of fluctuations should be avoided, because You cannot stay in the market with so much emotional stress. So this also should be avoided. Even though he is achieving positive return, this should be avoided because of the emotional stress you will get. Similarly, the 10% risk taking trader has with this light blue color, he has achieved or he has managed to stay positive. Okay, uh, but this again should be avoided due to the same reasons as I told for the 25% position size traders. I am telling you to avoid these two as well, even though they are giving positive returns, because we are not sure. This is just an illustration. Maybe if we enter into a losing streak, say this is a winning streak of three continuous winning trades. Similarly, if say at any point we enter into a losing streak of continuous three or four losses, then it's like we our capital will quickly get eroded, and that will definitely stress you out or will make you lose your discipline, and you will start taking random trades, or you will yeah, your making ability will be hampered. So what is recommended is 2% or 1% risk per trade. You see there, actually they are here, their payoff graph is very smooth. You see here, you see at the end they are making 3.9% and 2% return, which is fairly good, I would say. Okay, and there are no more drawdowns, there is no much emotional stress. They know that whatever may be the market movement, they are going to lose only 2% or 1% on any particular trade. Okay, so they have the risk in control very much, and they need not have to be worried about the outcome of any single trade, because they know that even if it is a failed trade, they can trade on the next trades and make up for that loss. So they always have that possibility of trading in the future and making up for those losses. But here these 100% or 75%, 50, 25, 10% risk taking traders, they are worried about each and every outcome of any given trade. So it's like this particular guy who was taking 100% risk on every trade, he when he took the first trade, he would have been worried about the trade, because he was taking 100% risk. So either he will make 1 lakh rupees on that trade, or he will lose all the 1 lakh rupees he is risking. So he have to worry about that trade, because that is the single trade he is making, and he is risking everything whatever he has, and if the outcome is negative, he will be out of the market. But these guys, they will need not have to worry about the outcome of any single trade. They worry about the outcome of say set of trades, maybe outcome of at the end of 10 trades. So here if you see the outcome at the end of those 10 trades is 3.9%, and for this guy it is 2%. Here yeah, what are the considerations I have done here? If you see this again I have done with very much calculation. I have taken one, two, three, four failed trades out of 10 trades. So remaining six trades are successful. That is, I have taken 60% accuracy or the success rate of the traders, which is like I'm not, since I am considering this for the novice or the new traders, I am considering their accuracy as 60%. If the accuracy increases, your chances of quickly increasing the trading capital or the account will increase, because your losing probabilities will decrease and in gaining probabilities will increase. So even with 2% position size, your account will grow quickly. That is my point. And yes, as I told, traders with the large position size will face large drawdowns, which can be stressful at times. Now, yes, good risk to reward. Here it is another thing. I have considered for this illustration, I have considered the risk to reward as 1 is to 1. But if the trader is experienced, if he gains experience as he goes on, um, continuing with his trading with the small position size, uh, and good risk to reward. Here in the last example I explained, here the risk to reward, the risk is only this one, okay, but the reward is huge. So if he continues like this, his possibility of multiplying or scaling up the account will be greater, because we are not just risking 3 rupees for 3 rupees, we are risking 3 rupees for 4 rupees. Okay, so that is a good risk to reward, and the gains will be good. For good risk to reward, you need to gain experience. You need to trail your stops logically so that your stops won't be hit, but you will also make sure that you will lock your uh, unrealized gains and don't give them back to the markets. Yes, with good risk, good position size, that is 2% or 1%, which are the only two recommended position sizes for the retail traders. Uh, they can manage the extended losing streaks. Even if the all 10 trades will be losing trades, what he is going to lose? He is going to lose only 2% on all those trades. uh, yeah, that will not lead to big losses. That will lead to just 20 5,000 loss, but his remaining 75 80,000 rupees of capital is intact, and he can still be in the market, continue trading, and hope to get back his money by trading, or trading with the experience that he has got, and he can try to improve from his experience. But these traders, if they get into such losing streak of 10 continuous trades, they will be out of the market. These all cross market traders. So that is why my recommendation is only these two position sizes, 2% or 1% per trade. Okay, so what are the positive outcomes of position sizing? Although I already explained all these points, but here is um, the points in which I have tried to explain it again. So, but in a different way. Here we know our stop loss beforehand. So this is a very positive thing for us. We know how much is we are going to lose. So at any point, we will not be stressed out. We will not take any random decisions. We will not cancel our stops and move them away from somewhere, this and that. We know our loss beforehand. What happens is, since when you calculate your position size, you would have already known your stop. That is when you can calculate your position size. As I explained here, it's like your stop loss price should be known, only then you can calculate your position size. Okay, that is why you are making very calculated decisions, very logical decisions to place your stops. The position size minimizes risk and maximizes returns, because We are taking limited risks, okay? And if your accuracy is good, this will maximize the returns. Obviously, uh, ultimately, to grow up your account, you need to make good decisions, or you need to take those profitable trades. Only then we can maximize the accounts. So the next is, yes, this brings discipline in your trading because of the reasons I already explained. And this definitely gives more room for your mistakes in the initial days, and this will even cover those extended losing streaks, and you need not have to worry at any point about uh, the outcomes of losing the whole capital. So this gives the peace of mind to trade. In short, the position size means how much quantity you choose per trade. Yes, what we should know for to calculate the position size is we should know our entry, we should know our stop. Uh, uh, I think that is enough to calculate the position size, and we should know the percentage of the capital we are risking, that is 2% or 1%. So with that, you can calculate the position size or the quantity that you need to deploy on any particular trade, or you need to buy or sell on any particular trade. The quantity, that is what is the position size. There are different ways of calculating the position size, and different people do it in the way that suits their trading methodology or their I would say the personality. So one is the percentage of total capital, and that is what I have illustrated in the last example. I have illustrated here the percentage of the total capital that we are risking. So that is the first way. So risking 2% or 1% on any particular trade. That is the one way. Second is the fixed amount. Fixed amount in the sense maybe you risk only 2000 rupees on any trade, irrespective of what your capital is. Okay, 2% on every trade. Maybe what happens in this particular percentage method is when as your capital decreases, the say for example you first risked 2% on the first trade, and that is a losing trade. So your remaining capital now is 98,000, right? Now on the next trade you will risk 2% of that remaining 98,000 and not 2% of the 1 lakh which was your initial capital. So this is kind of, it is always calculated on what is the remaining capital that you have, but in the fixed amount, whatever is your remaining capital, you are always taking the fixed amount risk. So even if you lose that 2000 on the first trade, you will again risk 2000 on the next trade, and so on. Even if your remaining capital is 50,000, you will risk again 2000 on the next particular trade. Sometimes, if our accuracy is good, this particular fixed amount risk or position size will work in our favor. Yeah, but what I would recommend for the newbies or the beginner traders is to go with the percentage way. Yeah. Now there is the third way as well, which is the varying quantity based on volatility. Say if there is a huge volatility in the markets and market is doing heavy swings up and down, then the probabilities of the stop loss getting hit are more. So there are traders who will take less risk during those times when the volatility is high. They take less risk, they will reduce the quantities or they will reduce their position size. But when the markets are less volatile, Okay, then they will increase their exposure by increasing the position size. Okay, so that is the way in which you can decide your position size. Obviously, if you want more information, you can comment on this YouTube video, and I will try to answer. And if you want to go very in depth, then you can obviously refer some material online to get more information. So if you have any questions, please comment and I'll try to answer. Please subscribe to this YouTube channel for similar videos. You can also give your video ideas at the end of the video, or I mean the comments. Okay. If you have liked this information, or if you found this video informative, please like the video and share with whoever is a beginner trader, novice trader, or a trader who is not able to do consistently in the market. You can share with them so that it will be useful for them to decide on how they can plan their position size to get benefited uh, in long term. And thank you. Uh, Bye.